Hello everyone. Hope you guys have watched my earlier video on insurance is not an investment, term insurance explain. So आज के वीडियो में I will talk about other life insurance plans which are there. I will explain in details how they work, what do they do and what are the disadvantages of having them. So let's get into it. First I will talk about is endowment plans. So what exactly are they? So endowment plans normally combine life insurance plus savings. A person pays premium for a fixed period of 10 to 25 years, and in case if the person survives the policy term, they get a maturity amount. And in case they die during the term, obviously the nominee gets the sum assured plus bonuses. They are often marketed as safe long-term savings plans. So what are the disadvantages of this? They have a very low life cover, definitely not enough for family protection. Returns are usually 4 to 6%, often below inflation. Long lock-in period they have, not transparent. Bonuses are generally unclear. They have poor liquidity because if you want to early exit, they have a penalty. So in short, they fail as an insurance and they fail as an investment. So let's get into the other one called as money back plans. So what are they? So money back plans generally give periodic payouts during the policy term. Example, 20% of the sum assured every 5 years, and whatever is the remaining amount is paid at maturity. That benefit is available during the term. Now, how do they actually work? So normally a policy term is for around 20 years. Money back is given at in the interval of 5, 10, 15, and the final payout is done at the uh, when the policy closes. So what are the disadvantages of it? The life cover keeps reducing after each payout. I don't think many of the people are aware of it. The periodic payouts receive reduced compounding. Lower real returns, definitely not suitable for wealth creation, and they definitely don't protect the money from inflation. They definitely look attractive, but they are financially inefficient. Okay, so let's get in to understand what is whole life insurance. So generally, whole life insurance provides coverage till the age of 99 or 100. So the premium payment may be lifelong or limited. Death benefit is paid whenever death occurs. Some plan offer maturity benefits at an old age. So that's how it works. So now, what are the problems with it? They have expensive premiums, returns are low and unclear, coverage often is insufficient, the structure is quite complex. Personally, if you ask me, there are better alternatives that exist instead of this. This policy sound good on paper, but they are weak in execution. So let's talk about the next one, which is called ULIP, Unit Linked Insurance Plan. What are ULIPs? Generally, they combine life insurance and market linked investment. So premium is split into two parts. One is insurance cover, second is investment in equity debt funds. They generally have a lock-in period of 5 years. So let's look into it, how they work, okay, and understand. So the first few definitely have high charges. I have personally experienced it because I had taken this policy. Once the lock-in period got over, the first thing that I did was close it. Later years, more money is invested, and definitely the return depends upon the market performance. So what are the disadvantages of having ULIP? High charges in early years, complex and hard to understand. Again, low insurance cover, switching and management fees. Personally, if you ask me, instead of ULIP, a person should do a mutual fund. It is definitely inefficient compared to other alternatives. So let's get into the another plan that I think we might have heard about it called guaranteed return or assured income plans. So what are these plans? Okay, generally these plan promises guaranteed maturity value or fixed monthly or a yearly income. They heavily use word like safe, guaranteed, risk free. And how do they work? Let me take an example for you. A person pays a premium for 10 to 15 years. receive incomes for next 20 to 30 years. Returns are mostly fixed in advance. That's how they actually work. Now, see, what is the problem with it? I'll tell you. The returns are usually between 4 to 6%. It is not inflation adjusted. They have a very long lock in period and low insurance cover. And the opportunity cost is huge. One thing we need to remember, guaranteed word doesn't mean it is good. Now, let's look into the last plan which I want to talk about. It's called child insurance plan. So, what are child plans? Normally, they are made or they are marketed designed to fund child's education or marriage future goals. They combine insurance on parents' life, investment component, and that's how they work. So, a parents pay premium, and in case if a parent dies, the insurer continues investment and the child receives the money at a certain milestone which has already been pre-decided. So you might be saying, Masood, what is wrong with it if you are planning something for the child and taking this plan? So let's look at the disadvantages it has. Okay, it is an emotional selling and poor math. It has low returns. It has lock in till child's adulthood. Poor flexibility. And if you personally ask me, mutual fund combined with term insurance will definitely work better. And one thing I want to say, love for children deserves better planning. So I want to conclude by saying this final truth. And please listen to me. The smart strategy which I want to tell you is, if you want protection, take term insurance. If you want to create wealth, take mutual fund. And if you want medical safety, please buy a health insurance. Now, what is the wrong strategy? If we think insurance as investment and get into the guaranteed trap. And I want to conclude by saying one line, and I think I would encourage you guys to remember this and say to yourself so you can avoid these traps. Insurance should save our family, not our money. I hope this video was informative and you learned something new today. And in case if you like the content, please do like my video and subscribe to my channel to get such more honest content on finance. Thank you and God bless you.